Every single month, money is quietly leaving your Social Security check before it ever reaches you. Not a scam, not a mistake. A deduction you set up once on a form most people can't even remember signing. And because you signed it, the SSA keeps pulling that money out month after month, even if the tax bill it was meant to cover no longer exists. In the next few minutes, I'll show you exactly what that form is, how to find out if it's draining your check right now, and the one page you file to make it stop. Before we get into it, subscribe and turn on the bell. This channel is built around the money the system never hands you automatically. The form is called the W-4V, the Voluntary Withholding Request. It's a one-page document that lets you ask the Social Security Administration to hold back a portion of your monthly benefit and send it to the IRS on your behalf to cover your federal income tax. You choose the percentage, 7%, 10%, 12%, or 22%. And from that point forward, every check is reduced by that amount. Think of it like asking your employer to withhold taxes from a paycheck. Except with Social Security, you have to ask. It's voluntary. And the word voluntary is doing a lot of work here. Because once you file that form, the SSA treats it as a standing instruction, indefinitely. Here's the part that catches people off guard. The SSA does not review your tax return. It does not check whether your financial situation changed since you signed that form. It doesn't know if you retired from a part-time job, if your pension ended, or if a new law dropped your tax liability to zero. It executes your original instruction every single month until you send a new one. So if you filed a W-4V 15 years ago when you were still drawing income from a second job, and that job is long gone, the same withholding percentage is still running, silently, on every check. Quick note before we go further. This is general information, not financial or legal advice. Please confirm your own situation with a qualified tax professional. And here's why this is worth a few minutes of your time. That money does come back every April in a refund, but between now and then, it sits with the federal government for up to 12 months, earning you nothing, while your budget is a little tighter than it has to be. We're talking about a few $100s a year, depending on your situation. Money you could be using right now. Here's the question you should be asking right now. Do I even have withholding set up? A lot of people don't know. The easiest way to check is to look at your most recent SSA 1099, the Social Security statement you receive in January each year. There's a line for federal tax withheld. If that number is greater than zero, withholding is active on your account. You can also check your payment stub if you receive paper statements, or log into your My Social Security account at ssa.gov and look at your benefit history. If tax is being withheld, the next question is whether the amount still makes sense. And to answer that, you need to understand how Social Security is actually taxed, because it doesn't work the way most people assume. Your Social Security benefit is not automatically taxable. Whether any portion of it is subject to federal income tax depends entirely on a number called your provisional income. And this is where a lot of people realize they've been sending money they don't owe. Here's how provisional income works. Take your income from everything outside of Social Security: pension payments, IRA withdrawals, interest, dividends, any part-time wages. Add any tax-exempt interest you receive. Then add 50% of your gross annual Social Security benefit. That total is your provisional income. If you file as a single taxpayer and your provisional income is below $25,000, none of your Social Security is federally taxable. Zero. If you're married filing jointly, that threshold is $32,000. Your correct withholding on Social Security in that situation is also zero, regardless of what your W-4V currently says. If your provisional income falls between $25,000 and $34,000 as a single filer, up to 50% of your benefit may be taxable. Above $34,000, up to 85% may be taxable. For married filers, those tiers start at $32,000 and $44,000. Here's something worth knowing about those numbers. They were set in the 1980s. They've never been adjusted for inflation, which means more retirees cross those thresholds every decade, even though their real purchasing power hasn't changed. But for many of the people watching this, especially those with modest fixed incomes, provisional income still falls below the line. And if yours does, withholding money from your check in advance is money leaving for a destination it was never supposed to reach. Take a few minutes and run this calculation using last year's income figures. It doesn't require a professional. It requires a piece of paper and the income numbers from your tax return. Now, if you're doing that math and your numbers are close to the line, or you're unsure which side of it you're on, there's something else that may have shifted things for you recently. A change that took effect in 2025 that we covered in depth in a separate video. The short version? Congress added a new deduction specifically for Americans 65 and older, stacked on top of the existing standard deduction. For many seniors with modest income, that change lowered their effective tax liability, in some cases to zero. If you set up withholding before 2025, your rate may no longer reflect what you actually owe under current law. That's the kind of thing that doesn't happen automatically. The SSA doesn't know about deductions. It only knows what you told it when you file the W-4V. Before we go further, do you currently have federal tax withheld from your Social Security check? Drop a yes or no in the comments right now. I'm genuinely curious how many people watching this have withholding set up and haven't thought about it in years. So you've run the provisional income calculation. You've looked at your 1099, and you've found that you're either below the tax threshold or paying more than your actual liability warrants. What do? The fix is straightforward. You file a new W-4V, one page. You can download it directly from irs.gov. Search W-4V and it'll come right up. You fill in your name, your Social Security number, and your benefit claim number from the SSA. Then you check the box that reflects your actual situation. If you're below the provisional income thresholds and owe nothing, you check the box to stop withholding. If you owe some tax, but not as much as your current rate implies, you select a lower percentage. Here's the one thing people get wrong about where to send it. The W-4V goes to your local Social Security office, not to the IRS, to the SSA. Processing typically takes 30 to 60 days. Your next check after processing will reflect the updated amount. That's it. One form, one mailing, and the change is permanent until you submit a new one. If you're not confident doing the provisional income calculation on your own, or if your tax situation has any complexity, a pension, rental income, an IRA you've been drawing from, I'd encourage you to get a second set of eyes before you submit. And you don't have to pay for that. VITA. That's VITA. Volunteer Income Tax Assistance. And TCE, Tax Counseling for the Elderly, are both free IRS programs staffed by trained volunteers. They specialize in exactly these situations: older adults, fixed incomes, Social Security taxation questions. You can reach the national line at 1-800-906-9887 to find a location near you. There is no charge for this service. One more thing worth mentioning before we wrap up. If you lost a spouse at any point and you're currently collecting Social Security, it's worth a call to the SSA to confirm you're receiving the right benefit. Surviving spouses can sometimes qualify for a higher survivor benefit than their own retirement benefit, and the SSA won't automatically make that switch. One call to 1-800-772-1213 to compare the two numbers is all it takes to find out. And while you're reviewing your withholding, make it a habit. Once a year, when your SSA 1099 arrives in January, look at that line for federal tax withheld. Compare it to what you actually owed on the previous year's return. If the numbers don't match, the W-4V is a one-page correction. Life changes, income changes, the tax law changes, and the SSA won't flag it for you. If this is useful to you, subscribe. There are more videos on this channel covering the rules and benefits that don't get explained in plain language anywhere else. And pass this along to someone you know who's on Social Security, especially anyone who hasn't looked at their withholding in a few years. They may be sending money to the IRS every month that they'll get back in April, but could be using right now.